Here's the brutal truth. Most people aren't failing at investing because they're not smart enough. They're failing because they're stuck doing the wrong things. Things that feel productive but are secretly dragging them down. If you're not seeing the returns you expect, if your portfolio feels like it's just treading water, chances are you're wasting time on strategies that don't work. This video is not about chasing the hottest stock or timing the market. It's about cutting out the dead weight, the strategies that waste your time, drain your money, and leave you frustrated while others grow their wealth with half the effort. Let's clean house. Because sometimes the best way to get ahead is to stop doing what's holding you back. Number 1, chasing the next big thing. We've all seen it. The expert on Twitter swears a certain stock is going to 10x. A friend says their cousin just made $40,000 off a meme coin. The temptation is real. So what do? You buy in. You ride the hype. You hope you're early, but more often than not, you're late. This is called FOMO, investing, fear of missing out, and it's a fast track to disappointment. Here's the thing, if everyone is talking about it, you're probably not early. By the time a stock or crypto trend hits the mainstream, the big money has already made its move. You're just exiting liquidity. Investing based on hype is not a strategy, it's a gamble, and gamblers usually lose. The wealthy? They don't chase, they choose. They pick long-term, proven investments. They research. They understand the business, the fundamentals, and the risks. Then they invest and wait. That's how real money is made. So, the next time you feel fear of missing out creeping in, pause. Ask yourself, is this a long-term investment, or am I just chasing heat? Number 2, day trading without an edge. Day trading looks sexy. Multiple monitors, quick profits, fast-paced lifestyle. But let's look at the stats. According to multiple studies, over 90% of day traders lose money. Not because they're lazy or dumb, but because the game is rigged for the few who have real skill, tech, and discipline. Unless you have a tested system, strict risk management, and emotional control like a robot, day trading is a time-wasting trap. You spend hours glued to charts, you stress over every tick, and in the end, even if you win, it's taxed like income. Compare that to long-term investing, where you can earn more with less effort and better tax treatment. Most wealthy investors aren't day traders. They're patient, strategic, focused on value, not noise. So, unless you have a professional-grade edge, let it go. Your time is better spent building a solid portfolio than chasing pennies in a hurricane. Number 3, obsessing over stock picking. Yes, picking the right stock can feel amazing, but here's a truth most people don't like to hear. Even professionals get it wrong, often. The Spiver report shows that over 85% of actively managed funds underperform the market over time. These are full-time fund managers with teams, data, and experience. What makes you think you'll consistently do better? Stock picking can feel smart, but it's often just luck. And if you're spending hours researching earnings reports, comparing price-to-earnings ratios, watching CNBC, and still not beating the market, you might be wasting your time. Index funds, on the other hand, are boring, but brutally effective. They don't try to beat the market. They are the market. And historically, they outperform most actively managed portfolios over the long term. Instead of obsessing over which stock will outperform, ask, why am I investing in this? Does it fit my plan? Is it proven? Boring is beautiful when it comes to compounding wealth. Number 4, timing the market. Here's a question. When was the last time someone accurately predicted the top or bottom of the market? And did it consistently? Exactly. Trying to time the market is like trying to catch a falling knife. It looks doable in theory, but in practice, it'll hurt. You wait for the perfect time to invest. You keep cash on the sidelines. You watch the market rise. You get in late, then it dips. You panic. You sell. Repeat. Here's what the data says. Missing just the 10 best days in the market over a 20-year period can cut your returns in half. And guess what? Those best days often come during bear markets, right when people are too scared to buy. The wealthy don't waste time timing the market. They have time in the market. They invest consistently, regardless of headlines. They focus on time, not timing. Dollar cost averaging, where you invest a fixed amount regularly, It beats market timing every time for most people. So stop waiting for the perfect moment. It doesn't exist. The best time to start was yesterday. The next best time is today. Don't forget to press the like button, comment, and subscribe to this channel to get more videos that could change the way you think about money forever. Let's move on. Number 5. Obsessing over penny stocks. We get it. The dream of turning $500 into $50,000 overnight is intoxicating. You hear about someone who made a killing on a penny stock, and suddenly you're watching YouTube videos at 2 a.m. thinking you've cracked the code. But here's what they don't tell you. Those stories are the exception, not the rule. Penny stocks are cheap for a reason. They're usually tied to companies with little to no proven track record, questionable financials, or even worse, no real business model at all. According to the SEC, many penny stocks are prone to fraud and manipulation. Pump and dump schemes are still rampant, especially in online forums and social media. You buy in after the pump, and by the time you realize what happened, the dump has already started. Instead of betting on lottery tickets, invest in businesses with fundamentals, real cash flow, real customers, and real growth. Don't gamble. Building, that's what the wealthy do. Number 6. Constantly checking the market. Here's a mindset shift that might save you a decade of anxiety. You don't need to check your portfolio every day or every week. If you're a long-term investor, and let's face it, that's how real wealth is built. Daily fluctuations mean nothing. The market goes up, it goes down, and sometimes it goes sideways for months. If your investment strategy is sound, time is your friend. The wealthy aren't refreshing their Robinhood app every 15 minutes. They're patient. They trust the process. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." So here's what you do instead. Set it and semi-forget it. Schedule a monthly or quarterly portfolio review. That's enough. Spend the rest of your time living your life or leveling up your skills. Constant checking won't make the market move in your favor. It will only increase your stress. Number 7. Buying high, selling low. This is one of the most expensive investing habits out there, and most people do it without realizing. The market crashes and panic sets in. You see red everywhere. You sell to stop the bleeding. Then the market recovers, as it always has, and you feel safe again, so you buy back in. Guess what? You just sold low and bought high. The exact opposite of what you should do. This cycle keeps repeating until your retirement account looks more like a roller coaster than a growth curve. The wealthy, they do the opposite. They see a crash as a discount. Stocks are on sale and they're buying not recklessly, but confident because they understand the value underneath the fear. To break this habit, zoom out. Look at a 10-year or 20-year stock chart of the S&P 500. See that, even with dips, wars, pandemics, and crashes, it trends up. The longer your horizon, the calmer you become. If you don't need the money for 5 or 10 years, don't act like you'll need it tomorrow. Let your future wealth grow in peace. Number 8. Ignoring index funds. If you're not a full-time investor, here's some brutal honesty. Stock picking probably isn't your game. You don't have to become the next Warren Buffett. In fact, Buffett himself recommends that most people invest in low-cost index funds. His will literally says to put 90% of his wife's inheritance into a simple S&P 500 index fund. That's how much he believes in them. Index funds don't try to beat the market. They are the market. And historically, the market has returned about 7 to 10% annually over the long term. That's with way less stress, risk, and time than picking individual stocks. The wealthy love index funds because they're boring but effective. And boring is beautiful when it comes to compounding wealth. Number 9. Investing without a goal. Investing without a goal is like getting in a car and just driving with no destination in mind. Eventually, you'll burn out or worse, crash. Are you investing for retirement, a house, your kids' education, freedom by 40? Your goal determines your timeline. Your timeline determines your strategy. And your strategy determines your investments. Without clarity, people jump from one hot stock to another, chasing trends instead of building towards something. Set clear goals, write them down, tie numbers and dates to them, then reverse engineer your investing strategy to support that vision. Number 10. Getting advice from the wrong people. Your broke cousin telling you to buy crypto isn't investment advice. Neither is the TikTok influencer who became a finance guru 6 months ago. If you wouldn't trade lives with them, don't trade stocks based on their advice. Instead, listen to people with a track record. Read books by seasoned investors. Follow those who've weathered multiple market cycles. Or, better yet, talk to a certified financial planner who has a fiduciary duty to help you, not sell you stuff. The wealthy surround themselves with people who are smarter and more experienced. They pay for mentorship. They ask questions. They learn. That's not weakness. That's wisdom. Number 11. Not investing at all. This is the biggest time waster of them all. You're afraid of making a mistake, so you do nothing. But in doing nothing, you're making the biggest mistake, letting inflation quietly erode your wealth. Money in a savings account isn't safe. It's shrinking, slowly. Every year you wait, you lose the one advantage you can never get back: time. You don't need to start big. Just start. $50 a month, $100, whatever you can. Automate it. Get in the game, then stay in the game. Because the people who win aren't the ones who started perfectly. They're the ones who stayed consistent. You don't need perfect timing. You don't need the next big thing. You need patience, strategy, and a little faith in the process. Investing isn't about luck. It's about behavior. And now that you know which behaviors to ditch, you're already ahead of 90% of people. If this video helped you shift your mindset, hit the like button and drop a comment letting us know which point hit hardest. And don't forget to subscribe for more content just like this, because your steps to financial freedom are just getting started. See you in the next one.